Yo, I ain't here for the money, I ain't here for the fame. Though it might be nice to own a jet plane,
Welcome back to the channel where we provide you with the latest information on stocks and finances. Today, we're going to be discussing the upcoming earnings report for Spotify, GM, Snapchat, and UPS. Let's start with Spotify. Wall Street expects a year-over-year decline in earnings on higher revenues when Spotify reports results for the quarter ended December 2022. The report is expected to be released on January 31, 2023. According to the Zacks consensus estimate, Spotify is expected to post a quarterly loss of $1.29 per share, representing a year-over-year change of -437.5%. Revenues are expected to be $3.26 billion, up 6% from the year-ago quarter. However, it's worth noting that the consensus EPS estimate for the quarter has been revised 9.96% lower over the last 30 days. This could be a sign that analysts have recently become more bearish on the company's earnings prospects. But, there's a tool called Zacks Earnings ESP which compares the most accurate estimate to the Zacks consensus estimate for the quarter. The most accurate estimate is a more recent version of the Zacks consensus EPS estimate, and it takes into account any estimate revisions made by analysts right before the earnings release. Our research shows that a positive earnings ESP is a strong predictor of an earnings beat, particularly when combined with a Zacks rank of number 1, number 2, or number 3. And in the case of Spotify, the most accurate estimate is higher than the Zacks consensus estimate, resulting in an earnings ESP of plus 1.17%. Additionally, the stock currently carries a Zacks rank of number 3. So, based on these indicators, it looks like Spotify will most likely beat the consensus EPS estimate when they release their earnings report on Tuesday morning. However, it's always important to keep in mind that past performance is not necessarily indicative of future results. In terms of Spotify's earnings surprise history, they have beaten consensus EPS estimates 2 times out of the last 4 quarters. So, it's worth keeping an eye on how they perform this time around. It's worth mentioning that Spotify has followed the lead of other big tech companies and cut 6% of their staff, which could impact the earnings. But overall, based on the analysis, the estimates are in line with what Spotify is likely to release on Tuesday morning. Next, let's talk about GM. General Motors is set to release its fourth quarter 2022 earnings on January 31st, before market open. According to the Zacks consensus estimate, the company is expected to report earnings per share of $1.63 and revenues of $41.54 billion. This represents a 20.7% increase in earnings per share and a 23.7% increase in revenue compared to the same quarter last year. In the last quarter, GM beat earnings estimates due to better than expected profits from its North America and international segments. Over the past 4 quarters, the company has topped earnings estimates 3 times and missed once, with an average surprise of 13.1%. One of the key factors that will shape General Motors' fourth quarter earnings is its strong sales performance in the United States. In the fourth quarter of 2022, GM was the top-selling carmaker in the country, with total sales increasing 41.4% year-over-year to 623,261 vehicles. Sales of Chevrolet, GMC, and Cadillac increased 43.3%, 42.3%, and 74.8%, respectively. The Zacks consensus estimate for the company's GMNA segment's wholesale vehicle sales is 798,000 units, an increase from 579,000 units in the fourth quarter of 2021. This, along with higher vehicle prices, is expected to drive revenues for the segment to $34,277 million, up from $26,865 million in the same quarter last year. The segment's operating profit is also expected to increase to $3,367 million, a 55.5% increase from the same quarter last year. The Zacks consensus estimate for the company's GMI segment's wholesale vehicle sales is 215,000 units, an increase from 163,000 units in the fourth quarter of 2021. The segment's revenues are expected to increase to $4,479 million, and the operating profit is expected to grow to $288 million. However, the company's GM financial unit is not expected to perform as well, with revenues forecasted to be $3,258 million, a slight increase from $3,232 million in the corresponding quarter of 2021. The company's operating profit is expected to fall to $775 million, down from $1,180 million in the same quarter last year. Additionally, the GM Cruise unit is expected to have an operating loss of $445 million, widening from $349 million in the year-ago period. Overall, while higher year-over-year shipments and revenues from the GMNA and GMI segments are positive, weak forecasts from the GM Financial and GM Cruise units dim the overall fourth quarter outlook. Additionally, high commodity costs, including platinum group metals and steel prices, are expected to be a headwind for the company. General Motors estimates that these headwinds will be more than $5 billion higher from 2021 levels and from its prior projection, further softening the outlook for the to-be-reported quarter. According to our earnings whisper model, General Motors is not expected to beat earnings estimates for this quarter, due to a positive earnings ESP of plus 4.15% and a ZAX rank of 4, sell. Last but not least, Snap, is set to report its Q3 earnings on October 20th, and the results will be closely watched by investors. The stock has seen a significant decline over the past year, trading 86% off its 52-week high of $78.18. The company is the first social media stock to report in the current quarter, followed by Twitter, Meta Platforms, and Pinterest. The release will also provide insight into the effects of Apple's privacy changes on the social media industry, which caused a $300 billion market value loss for social media platforms. Snap's Q3 earnings report is particularly important for the stock as it lost most of its value after its last two quarterly reports. After a string of positive earnings beats, investors and Wall Street had become optimistic about Snap's growth. However, the company's recent earnings reports revealed the headwinds most social media platforms are facing with slowing ad revenue. In Q2, the company did not provide any guidance or outlook for the current quarter, citing challenging forward-looking visibility. This led to a further sell-off in the stock, as the Q2 earnings were affected by rising operating costs and slowing advertising revenue. In addition, Snap also attributed the slowdown in demand for its online ad platform to rising competition from TikTok. Despite not providing guidance for Q3, Snap's daily active users, DAUs, were up 18% year-over-year during Q2 at 347 million. DAUs increased sequentially and year-over-year in North America, Europe, and the rest of the world. This could still attract major marketers to Snap's online ad platform, potentially increasing its growth outlook once economic conditions stabilize for its advertisers. The ZAX consensus estimate for Snap's Q3 earnings is a loss of -1 cent per share, down from 17 cents per share in Q3 2020. Sales for Q3 are expected to be up 5% at $1.13 billion, reflecting that operating costs affected the company's bottom line during the quarter rather than slowing ad revenue. Earnings estimates for the period have gone down from 3 cents at the beginning of the quarter but started to rise from -2 cents 30 days ago. Overall, investors will be looking for Snap to beat earnings expectations, and for the company to provide some type of guidance for Q4 and FY23. If Snap is able to do this, the stock could rebound. While many social media platforms are currently experiencing lower ad revenue, their advertisers are expected to adapt to the current market environment. Since last earnings the company did not provide guidance it could potential surprise, it is worth noting that there have been quite a few call sweeps near the ask of $20 call option. We feel like Snap will surprise and we are going long. Lastly, UPS. According to Wall Street, UPS is expected to report a decline in earnings for the quarter ended December 2022, with higher revenues. This widely known consensus outlook is important in gauging the company's earnings picture, but it's worth noting that how the actual results compare to these estimates could have a big impact on the stock's near-term price. The earnings report is expected to be released on January 31, 2023, and if the results are better than expectations, it could potentially send the stock higher. However, if they miss, the stock may move lower. UPS is expected to post quarterly earnings of $3.58 per share in this upcoming report, which represents a year-over-year change of -0.3%. Revenues are expected to be $27.95 billion, up 0.6% from the year-ago quarter. The consensus EPS estimate for the quarter has been revised 1.33% lower over the last 30 days. This revision in estimates may suggest that analysts have recently become bearish on the company's earnings prospects, which has resulted in an earnings ESP of -1.21%. Additionally, the stock currently carries a ZAX rank of number 3, making it difficult to predict if UPS will beat the consensus EPS estimate. However, it's worth looking at the company's surprise history to gauge its influence on the upcoming number. For the last reported quarter, UPS beat earnings estimates by posting earnings of $2.99 per share, instead of the expected $2.84 per share, delivering a surprise of plus 5.28%. Over the last 4 quarters, the company has beaten consensus EPS estimates 4 times. So, while the consensus outlook for UPS's Q4 earnings is for a decline, there's still potential for an earnings surprise, and investors should keep an eye on the company's earnings report on January 31st Street. As always, it's important to do your own research and consider your own risk tolerance before making any investment decisions. Let us know in the comments your thoughts on the stocks we covered and if you think it's a good time to buy the stock. As always, thank you for watching, and we'll see you in the next video where we'll be analyzing the upcoming earnings for another company.